We have a trade on in CZR, Caesars Entertainment. We've made several adjustments along the way. Let's recap and go back to where this trade started, and we'll walk through the steps that we took to show how this trade has evolved over time. So this is going back to Friday, May 21st. We initiated a long call vertical. We bought the 95, we sold the 105 calls. This is a 10-point wide call debit spread. We paid $4.90 for it. Initially, we were looking for price to break out above 105 and take us much higher. That did not happen. Well, at least initially it kind of did, but then it didn't. So this is where this trade has started. We're going to go to the next adjustment point, and this was 3 days later. We have move up to about 103, 104. What we did was we sold the 105, 110 call credit spread against the 95, 105 call debit spread. The credit we collected here was $2.85, which went to reduce our risk from 490 to about 285. This was 3 days in this trade. We're gonna go to the next adjustment. This was 20 days after this trade was initiated. So the price has breached our short call spread, which is totally fine since we had no risk on the upside. Now the price is right at 110. What we did is we sold the 130, 135 call credit spread. We took in another dollar, which went towards reducing our risk further from 285 down to 185, but selling the 130, 135 has introduced risk on the upside. We have $5 worth of risk by selling the 105, 110. We have another $5 risk from selling the 130, 135, which made this a kind of a balanced condor, if you will. This is a combination of a broken wing call butterfly with a short call spread, which equalized risk both on the upside and on the downside at around $185 on each side. This was 20 days after this trade was initiated. The underlying has moved about 0.8 standard deviations to the upside, so we were essentially right on the outlook for the price. Right, we were looking for a breakout. It looks like things were kind of stalling out a little bit. We were up against the one standard deviation band, so to speak. So we neutralized the trade here, just looking to burn some time off the clock. At this point, this was on June 10th. We had 99 days until expiration, so plenty of time. Price can go way higher or much lower. So we decided to take a delta neutral position and kind of see what happens next. Now we can go forward in time to where we are today. As we can see that since the last adjustment, prices come down outside of our profit tent or profit area. And today we have a move to the upside. Prices kind of moving back towards the profit area here. Now we only have 23 days until expiration, and every day that goes by, this trade is going to become more and more sensitive to price change. If we see price move higher, which is going to play in our favor, which is what we want to see, that'll be great. If the price goes back the other way towards 90, this isn't going to be as much fun. So what I would consider doing here with this trade is, remember, we sold the 130, 135 for $1. If we were to buy back that call spread, so buying back the 130, selling back the 135, this is going for a penny. So if you buy it back for a penny or two, I wouldn't go paying too much more than maybe a nickel for it. Capturing 95 cents worth of profit from that short call spread. So that would be my adjustment number one. So we're buying back the 130, 135. This puts us back into a broken wing call butterfly. 95, 105, 110. This does nothing to reduce our risk on the downside. So the next adjustment I would consider doing here is taking my in the money 95 call, which is currently going for about 570. So I'm selling to close the 95 and I'm going to buy to open the 100. This adjustment is going to put me into a risk-free balanced call butterfly. We have 5-point wings. The body of this butterfly is at 105. What this means is that if this stock expires outside of 100 to the downside, we're going to make about $50. If the price expires above 110, we're going to make about $50. And if the price is somewhere inside 100 and 110, we could potentially make up to $5 worth of profit plus the $50 profit that we are going to carry forward. We have a max potential profit here of $550, and we have no risk to the downside and no risk to the upside. So adjustments here are to buy to close the 130, 135 for, it's currently going for about a penny. So I'm going to try to buy it back for maybe 2-3 cents. And I'm going to look to roll the original long 95 call up to 100 strike. So I'm making a 5-point roll. It's currently going for about $2.30, 230, 235 credit. This is going to completely eliminate any risk on the downside and on the upside. I'm going to hold on to this trade for another couple of weeks. There's no risk, so I'm not going to look at it too often. I'm going to try to hold it as close to expiration as possible. Again, best case scenario, we get a pin at 105. That's going to be the best case. We're somewhere inside the tent. We have a potential to make maybe $150, maybe $160. One thing to consider is the fact that if the stock is above 105, since we are short 2 of the 105s, they're going to be in the money. In the money options do have risk of being assigned. So that is always a risk, but as long as there's time until expiration and those options have some extrinsic value, the risk of getting early assignment is not as great. So I wouldn't worry about it too much, but we do need to keep that in mind. If you don't want to deal with early assignments and figuring out ways to exit out of the position, I would just consider closing out the whole thing maybe with 2 weeks before expiration. So the idea here is to close out the 130, 135, roll the 95 up to 100. We'll have a risk-free trade. And I don't think I'm going to make any more adjustments other than closing out this trade with about 7 days until expiration.